Well, let's get started. Thank you, Marty, for inviting me to do this. This is my inaugural event, and I'm looking forward to learning more about the real estate space that all of you are in. Why don't we start with each of us, you two, let's start with Max. Max, why don't you introduce yourself and tell us a little bit about the business that you're in and what you're doing.
Yeah, absolutely. Hi, everyone. I'm the CEO and co-founder of Fulcrum Lending. We're a digital mortgage company focused on multifamily lending nationwide. We are, first lien providers of debt, higher leverage, up to 85, sometimes 90%, with an appropriate interest rate there. We started off our business focused on the agency lending space with a variety of partnerships we've had, and kind of somewhat of a new lens to multifamily lending with regard to investing our own balance sheet capital. So we use Fulcrum Lending as our vehicle to deploy balance sheet capital for bridge loans.
Okay, thank you. So Peter, tell us a little bit about your organization.
Yeah. So my name is Peter Powers. I'm a second generation member of MPI Family Office. MPI Family Office is a first generation family office based out of Tampa Bay. I'm part of the second generation. We got our start in the medical space. My father and uncle started and operated diabetic care facilities on the west coast of Florida, and then about a decade and a half ago took that and leveraged it into a family office where we built a pretty healthy portfolio of real estate and other operating businesses. I run the real estate platforms that includes multifamily, self-storage, and senior housing. And we have right around $1 billion to $1.25 billion of real estate across the country.
Excellent. And last but not least, Remy.
Yes, Remy Raisner, founder and CEO of the Raisner Group. We're a 13-year-old company now. I started the company in the last financial crisis, in the great financial crisis 2009. I was buying non-performing notes. Converted that into multifamily ownership in Brooklyn, and today we're only involved in Brooklyn, and therefore only involved in New York City. We own about 40 buildings that are primarily public buildings, and we also own some mixed buildings. We're concentrated in the changing areas of North Central Brooklyn, Bed-Stuy, Bushwick, and West Garden. That's what we do.
Excellent. I've been to those neighborhoods, and anyone under 30 wants to be there. So
I'm way over that.
Well, we will ask.
I want to be there.
Yeah, no, we thought about it. We're thinking about relocating, so get a lot of value there.
I got a couple of retail units for you guys.
Okay, retail, not so much. I like your apartments.
Oh, I thought you were Corcoran.
Okay.
So you guys are there already.
Yeah, we're out there. Corcoran is everywhere, all over the country now. Tell us a little bit about the opportunities that you're looking for in real estate from your own perspective, your business. Why don't we start with Peter?
Mm-hmm.
Tell me, we spoke a little bit, but what kind of opportunities are you looking for?
Yeah, so being a family office, we're very flexible. So we focus on multifamily housing, senior housing, and self-storage. But once you break that down, we're always pivoting. I guess I'll use multifamily as an example. We were just in the traditional conventional space, and then over the last couple of years have pivoted to getting into more of the affordable space. So that is through our LIHTC platform, and then we've also been doing that through our hotel to apartment conversion platform. So we're doing that all across the country as well. So we're big believers that there's a tremendous need for affordable housing, and we want to be able to provide a solution for that. And I think just given the price of construction costs, and given the value of a lot of these traditional apartment communities, they've increased so much. It's just you can't provide a solution for the housing right now. So you have to get a little bit creative, and that's why we've really taken a deep dive into the conversions, and why we're buying a lot of LIHTC communities across mostly the Southeast. So
you're in Tampa now?
I'm in St. Petersburg, but yes, Tampa Bay.
Excellent. Maxwell, tell us a little bit about the opportunities that would attract you.
Yeah, similar to what Peter is saying around the affordable housing if you want to call it, dilemma our country's facing. It's certainly something we want to address. Fannie, Freddie, FHA, they have great programs that really focus and promote affordable housing. And as such, they provide, competitive loan products that, are mainly geared towards affordable housing providers. And whether it's an actually, regulated affordable housing project or something where it's just achieving inline rents or below AMI rents, they're certainly promoting that. I think there's a space and certainly a gap between truly affordable housing and market rate housing, if you want to call it, attainable housing or kind of moderate, that really isn't being addressed. And if you want to make an analogy to maybe middle class America kind of being left out in terms of the social programs there, I think we, have we found a nice spot, a nice kind of ramp into this space by focusing on moderately affordable properties. And how we make it work is very similar to Freddie and Fannie, where they're offloading the risk to note investors. Similarly, we're offloading the same risk to family office and private credit investors. And that's really what allows us to provide competitive interest rates, higher leverage. And this is all with the backdrop of course, inflation being on top of everyone's mind. And we see that as only a greater amount of downside protection and really coverage, asset coverage when we're thinking about these higher leverage loans. The other side again is really making sure that we are providing banded returns to our investors. And we think that first lien mortgages and, via bridge loans, so closed within 30 days, is a great spot to be. And by recycling capital with the vast amount of data that we use in leverage, we have about 60% of the multifamily data in the US. We're able to move quickly and finance quickly. And that's really kind of the secret sauce to be able to create a robust and agile lending company, especially focused on these affordable housing developments.
Okay, thank you. Remy, tell me a little bit about your business. Does it overlap what you're talking about in terms of, I'm sure financing now is a challenge. Tell me a little bit about your opportunities that you're looking for.
I guess the way we overlap is we target affordable housing or somewhat affordable housing within New York City, which would mean our portfolio is, our business plan is at $2,500 for a two-bedroom apartment. That's our clientele, so to speak, so it's more affordable than many parts of Manhattan, many parts of Brooklyn as well. It's going up, it's trending towards $3,000 per, the number is becoming more than $3,000. In hindsight, we're different in the sense that we target New York stock, many times walk-up buildings, non-elevator, mid-sized to small buildings. That's our bread and butter business, very concentrated in certain areas, which I mentioned before. We're also geographically, New York, at least until recently, has been lagging the rest of the country. Obviously, in real estate, markets have been on fire in the southern belt. Phoenix, the rents went up 30%. Austin, we discussed before, where the other panels are in Florida. We're lagging. We're coming back, and we think it's the right environment to be very aggressive. So we're about $2 billion last year. We continue to buy very aggressively. We started really pushing the button on purchases late 2020. At that time in New York City, you had no buyers. Rents went down 30%. It's a very different picture. And at this stage, I want to say the way we look at the business and where we are in terms of the time in the cycle, I think we're very positive about the market. We're just getting back pre-COVID rents. I want to say now we got to be leasing. Most units, which New York City don't have outdoor space, are still probably realistically about 10% below what they were pre-COVID. But I think I'm looking forward to leasing season. I think they're going to finally bounce quite back, just maybe because of general inflation and people gradually moving back to New York. So that's where we are in the cycle, and that's where we're for the business.
I personally think you're in a great position. I think all companies that are moving back, Google, Facebook, and New York City is attracting a ton of new people, and we have a shortage, and we're in a good position. So that kind of brings us to the pandemic and how it kind of irrevocably changed work and living situations across the country, across the world. Talk a little bit about how the pandemic has affected your business model. Has it changed anything permanently? And where do you see us going forward? Remy talked a little bit about rents in New York. They bottomed out. We were giving away 3-4 months free rent to get somebody into an apartment 2 years ago, and now we can't find an apartment, and there's bidding wars. What's it like for the rest of the country, and how does it affect your business model? So why don't we start with Peter?
Yeah, so if anything, we've doubled down on our business models. We've definitely pivoted a good bit. Before the pandemic, we were looking at purchasing extended stay hotels across the country and going through the conversion process for both multifamily as well as senior housing. Since the onset of COVID, right when COVID happened and a lot of these assets got hit pretty hard, we made the jump. I mean, it was we saw a real opportunity to buy these assets at discounted rates. We weren't necessarily buying many of them at distressed prices. Going through the whole, we teamed up with a group out of California to do the renovations, and the projects have been gone very, very well. We acquired 7 hotels last year, and we're in various different phases of doing the conversions, and we have another several under contract right now. So we've put more time and energy into that. I think with the rent increases you saw across the country, and we knew there was an affordability problem, but it's really became it got a lot worse. I mean, look at some of the markets across Florida. Some of them like Tampa Bay, like Jacksonville, even West Palm Beach. The average rents were below the national average, and then you look at now, some of them are 15-20% above the national average. That's a pretty big swing. So what we've done is we've looked at other solutions. One of those being getting involved into manufactured housing to again provide another solution for the affordability crisis. But a little bit of an issue that we're running into, and maybe Maxwell or Remy could assist, is you can't get the typical leverage for these manufactured homes. Even with the hotel conversions, it's a little bit tricky because sometimes your units are below 300, 350 square feet, some of them. And Fannie and Freddie, the typical agency lenders, they don't like that. So that's the headwinds we're facing right now, but we've been making a lot of progress.
So would either of you like to comment on that and the affordability and what affordable housing sounds like? Because it's got a little bit of a negative connotation, but I think it's, as you said, there's a major market, there's a need for it. Where are we going in the future? What needs to happen?
I think Peter brings up a really great point in terms of how Freddie and Fannie and just the agencies broadly look at financing these type of properties. It's frankly I would say new for the US. I mean, in terms of a type of housing. I mean, if you want to think back to tenement styles, I think we're very, very far from that, but maybe that's the connotation that you're referencing.
Mm-hmm.
But at the end of the day, people need a place to live. That's always been kind of like one of the pillars in real estate investment, which is there is a utility play, right? And supply demand factors are truly at play here. And you look at even during the pandemic, right? You saw the market just crater, but also double back in a major way. And you also look at where interest rates went, right? You see this short spike and then a drop down. And that's because multifamily and housing in general is a major factor of the US economy and just GDP in general, right? If you think about wallet share, right, the average American puts in maybe 20 to, in high cost city, 30% of their gross income into rent or mortgage or just living costs. So, I mean, it moves the needle in a major way, and finding a way to finance folks that are looking for opportunity, like Peter mentioned, in by hotel conversions or manufactured housing, right? If we aren't recognizing that value creation on the financing side, we are drawing a lot of liquidity out of the space and therefore innovation out of the space.
Mhm.
Liquidity should follow innovation. And that's where we see a really sweet spot in the market, and that these lenders are massive, but as such, right? Like a battleship, it takes a long time to maneuver. So
Mhm.
they have the benefit of scale to offer these securitized products essentially for multifamily investors, but these multifamily bond investors who are on the other side buying that yield, right? They just aren't recognizing that value either. So there's a bit of a disconnect, and that's where I think private credit comes in to fill that gap, because there is that yield, and so long as you can, as I mentioned earlier, recycle that capital efficiently, you have really high returns on equity in this business.
Mhm.
And that should really guide how, the properties that you're financing, the sectors you're financing and focusing on.
Yeah, I agree. And I think it's 1 out of 4 renter households are spending over 50% of their income on housing. So you look at that, that's a huge issue.
Huge.
So, I know what we're doing, most of it is going to be catering to, single individuals, maybe boyfriend and girlfriend or husband and a wife, but just because the units are smaller, but you are seeing it in 2 different areas. We have a growing a senior demographic. So when we look at these conversions, you're seeing a lot of the recent college grads, the millennials, but you're also seeing these seniors that are on fixed income. At the end of the day, they can only afford what they can afford, and we got to remember that. So, I'm hopeful that the agencies will understand that, and will guide the financing in a direction where it's more it'll infuse capital into that, because again, Fannie and Freddie have a huge advantage, and if they could do that, there'd be a huge incentive for other groups to get involved, and so again, at least put a dent into this problem, because we're having more and more seniors every day. Now we used to say it was you have 10,000 seniors turning 65 every day. Now it's 10,000 turned 70. So you're getting older and older. So we're well into that. And a lot of them are seeing, come to our property to lease, and on, Social Security. And again, that the Social Security is not keeping up with inflation. And our products are typically, 10, 15, 20% below the market. So it gives them a good place to live.
Excellent. Let's hear from Remy, and I'll get you.
So it's funny for us, the picture is this. New York City, given where things are in the rest of the country and where things are with the city, relatively has not been as cheap of a place in forever, basically. It's almost as expensive now to live in downtown Dallas, Texas, or Austin as to live as on the Brooklyn waterfront or other parts of Manhattan. So not to say that New York's affordable, but relatively it's extremely affordable compared to other locations. New York is New York. This is where we're still the capital of the world. This is where the jobs are and whatnot. So again, that makes us feel good about the outlook going forward for investments. Generally speaking, the supply-demand equation is very lopsided, more than it's ever been, for 2 factors primarily. Number one, so New York has heavy rent stabilization laws, as many people would know. You have 1 million apartments in the city that are rent stabilized. So that's 1 million out of 3 million apartments within the New York City limits. Prior to 2019 and the change in the rent laws, you could convert rent stabilized apartments into free market apartments. Half of the supply of new free market apartments was made up of converted rent stabilized apartment. That went away at the stroke of the pen with the 2019 rent laws that basically made rent control, rent stabilization permanent. So half the supply got nixed. After that, unfortunately, the pandemic hit and delayed a ton of projects. And when they didn't delay projects, they made a lot of others unaffordable or uneconomical and therefore canceled. So the supply again got constrained and delayed, took longer to come to market. So there's no question I mean, we have new politics at the governor's level and the mayor's level. There's no question in terms of affordability. We need to keep things. I mean, we need to keep building and delivering free market housing in a major way for the health of the city. But outside of that, the equation, the supply-demand equation, is extremely dramatic, put it this way, right now because of the shift of the recent years.
We'll continue. So talk a little bit about
I have a
incentives.
question from the
Oh,
audience.
excuse me. Let's-
Yeah, sure. Two different questions. One quick answer. The three gentlemen, what is your, define affordable housing in your respective sectors? What's the price point, in terms of the style of whatever? So in your area, in the greater New York area, in other parts, what is defined as affordable housing? Is it a certain rent level? Is it a certain price level? Give me a flavor so that
I think you have different definitions. Affordable in the sense that people can afford it.
Right.
In the free market, I would call it what we do, $2,500 for a two-bedroom apartment. That equates to about $40 a foot. Other definition is more of a legal definition, meaning what qualifies for light tech, tax credits, what falls under rent stabilization laws, things of that nature.
So you say 2,500 roughly, two bedroom is what is considered affordable in New York?
Within the New York City market, roughly.
How about these gentlemen? What's
Yeah,
the-
no, I'll answer that. So let me take a step back. So when we first started looking at affordable and workforce, this was 5-7 years ago, especially in like the Southeast, and some of the markets in Texas and Arizona. Affordable would have been, rents, for, I guess a two bedroom, you use that as an example, between $750 to $1,100 is what affordable would have been. Fast forward to now, it's starting right around $1,000, high 900s to probably $1,300, $1,400 is what we're looking at. And that's what we're seeing in the markets like Atlanta, the markets like Charlotte, the markets like Tucson, Phoenix, and then in some markets in Texas. So that's what we're seeing as affordable. And then on Remy brought up the light tech space. That just depends on the area, but it's typically 60% of the area and median income. So we own, a couple assets in Atlanta and some stuff in the Mid-Atlantic. That's typically, starts around high 800s and goes up to, let's call it $1,100-$1,200 for a three bedroom, but they are income restricted.
Max?
Yeah, so in terms of what Peter and Remy were saying, there's a dollar value, right? But what we look at is relative affordability, and then in terms of absolute cost, but also relative to the income. Income is really the biggest driver for us. We're able to track AMI growth and down to the MSA or county, and we want to see anywhere from 20 to 25. And then that ratchets upwards for the greater amount of bedrooms, but that's around the percentages that we're looking for in terms of AMI for the area. For certain areas where, housing is just really cheap relative to even a percentage of their income, right? We think those are markets that have room to grow substantially. So, we'll have the extra focus there. But we look at it on two bases, absolute and relative.
Okay, the other question that relates to that is, I don't know if anybody's heard anything about the opportunity zones. That seems to be gone in terms of the discussion today. But how does opportunity zone perhaps either interplay or affect affordable housing? Is there an interplay there between what's being developed in cities, opportunity zones, and the areas of affordable housing around those opportunity zones and whatnot? Or is that just a silly question?
No, it's a great question. It's actually not gone. We actually have more requests now than before, than prior to the pandemic, about opportunity zones. The primary reason, this was passed, I think, in 2017, late 2017 with the Trump's Act. But so you can basically roll over capital gains from liquid securities, that into real estate. Well, after the pandemic, people have a lot more of those gains. So that's created actually more demand. At least for us, for what we see.
Well, one thing I want to, sorry,
Well, everywhere. We're Brooklyn based and Brooklyn focused, but
Okay, yeah, jump in, sorry. Okay, yeah, gents?
Sorry, Peter.
one thing I wanted to add is, the big impact that we're seeing, we're looking at an opportunity zone right now. We always look at real estate first, and then if it's an opportunity zone, that's great. But one thing I wanted to point out, and I think the real advantage with these is they're in areas that may have not seen a lot of capital. That was the whole reason for them. So, you're going to see the households that have homes near those locations and that have developments that go on there, it's going to help bring them more equity into their homes. It's going to provide more opportunities for them because then they can refi it out or they could sell it and move somewhere else. So it's going to give them some upward mobility once they get, more, I guess, essentially liquidity, cash, whatever you want to call it.
Max?
We're talking a lot about social impacts of what we do, and how this asset relates to family office that may have a mission of social impact investing. Do you think that family offices are uniquely positioned to approach this sector in a more humane way, I guess? I don't know if that's a real term, but.
I could answer part of that, or Max, or
Please, I'd
me.
love to hear that.
Go for it. I think you're.
Yeah. So the one thing I want to point out there, and I'll keep it brief, is, we look at being very conservative with our investments. And for us, being conservative right now in the real estate space, the housing space is catering more to the workforce and affordable. So I think that a lot of family offices are very similar to us, at least the ones I speak to. So I think it's kind of a safe bet. If you want to get involved into something where there's a tremendous amount of people that are looking to live there and it's really, very much in need, I think getting into affordable housing, getting into workforce housing, it's a no-brainer. So that's what we're seeing, that's what we're hearing, and that's what we're putting our money where our mouth is. We're putting it towards that because we see capital preservation as well as the cash flow, as well as the appreciation.
I would echo what Peter is saying in terms of, look, you can take it from an equity or debt position. At the end of the day, equity is the tip of the arrow, and they're the ones that should be the owner operators on the ground. They know what communities need what, and that's one thing you can't overlook. Where we come in is, okay, how do we just lessen the burden of capital raising? How do we help you acquire more properties? How do we help you kind of double down on the strategy? And it's all with the lens towards providing liquidity towards, again, as I mentioned, innovative investment strategies or innovative housing products. And again, I think the credit markets often lag what is kind of at an inflection point, because I think most credit investors are very old school in the sense where it needs to have this tried and true track record of at least a decade. And you're seeing, the ups and downs and standard deviation movements and risk. But, the way I look at investing, I started off on the equity, in particular the distressed equity side, is that, it's all about shapes and recognizing what is that shape of risk and what is that shape of return. And you're constantly trying to mitigate the risk and enhance returns in some way when you really just boil it down. So again, it just depends. As a family office, are you looking for, oftentimes, which is the case, it's just principal protection and then some growth with current income. Some of them are more aggressive. If you're kind of just being handed the reins, perhaps there is a shift in terms of focus where, if you're an industrialist family of sorts and you want to start moving into technology, or let's say retail or office, right? If that was a big thematic investment previously, but the next gen is interested in affordable housing and ESG layer to it, multifamily plays a role there. But it's really about just defining what those income and wealth generation goals are with, what your objective is as your mission in deploying capital, and the impact that you'll be measuring there. And again, the way you look at equity and credit is just how you band the risk and how you band the return. And that's how I think of it.
Anybody else?
Oh, I guess I'm the only one.
If you want.
Yeah, sure. Look, I mean, how can family office invest in a socially conscious way or whatnot? I think there's a lot of ways. It depends also how you define that. Primarily, I would say, in our case, if you invest with a sponsor that, takes a long-term view on certain neighborhoods, invest in places that might be more desolate than others, before any change of these areas, create jobs, restore significant architecture. That's one way. Maybe another way is to just directly invest in opportunity zones which are specifically targeted. If you go by the census map, and another way, I guess there are many other ways, but absolutely the answer is yes. Family office can do that.
I'm happy to hear that. So next area is climate and climate change. Whether you believe in it or not, I think it affects real estate more than any other asset. Both the reality of weather as well as climate initiatives and the politics behind it. How has the new reality kind of changed your approach to your business? So Peter, why don't we start with you?
Yeah. So I think, again, I'm gonna go back to hotel conversions. I mean, it's probably one of the most efficient uses of capital, as well as it's very eco-friendly. Instead of going there, disrupting land, tearing down trees, tearing up land, you're repurposing something. You're taking something that is, it's not necessarily as much in use and isn't necessarily the prettiest thing, and you're making them, look, make them fit in better and making them, kind of re-envisioning them. So, and again, a lot of the structures we're buying, 70s, 80s vintage, a lot of it is more, it works very well for today because it's not too hard to make the style very modern. So we've done a great job of taking those spaces, taking the units, working with what we already have. Occasionally we'll knock down walls to, combine the units, and then, you're taking, the common areas like the conference rooms, you're making those into amenities. So we're using every part of that hotel to, make it more accessible to the residents. Maybe they only have a 300-400 square foot unit, but they have co-working, they have a 1,500 or 2,000 square foot gym. They're in great locations. So, that's what we're doing. That again, I see as very, more eco-friendly than a traditional development.
Remy, why don't you tell me about how climate's affected Brooklyn specifically, and you do ground up or you do mostly rehab?
We only buy existing buildings and we rehab and rehabs, no ground up. It's been a strategy so far. So it's funny, when I started the company over 10 years ago, I have a very good friend who's a scientist, and actually had a long conversation with him, and I was particularly comfortable investing where we're in Brooklyn because that's the highest point in the world. Actually, maybe the highest point in New York City. The very specifically highest point in Brooklyn is actually Crown Heights, which is very good where we are. So for that reason, we haven't had any particular concern going forward with changing in terms of rising water and whatnot. We haven't really invested in the waterfront for many reasons. That's one of them. But other than that, the only real concern has been Ida to some degree, but we had only minor damage, thankfully. At the end of the day, it's linked to climate change. If you believe that there will be more storms and hurricanes and just events like this. On the other hand, it's also due to the sewage system of the city. So it's a twofold issue. But we're in terms of going forward with this strategy, we're at a high geographical point, so that's been beneficial to us so far.
Things are different in Florida and coastal regions. Can you speak a little bit about those areas and what, there's politics involved too, but what's the reality and what type of initiatives are beneficial in some, and which ones look like window dressing or greenwashing?
Greenwashing is definitely a real issue. I think that I think investors need to be wary of that because at the end of the day, you gotta look at the incentives that put also extra dollars in the operators' pockets and the people who are taking the risk and spearheading affordability in these markets. And an example of I'll share how the agencies look at it is if you're LEED certified or you have a green certification, you'll get some discount in the interest rate, anywhere from 30 bips to 15, sometimes greater, depending on the combination of factors. But the more green the building can be, certainly the better it is for not only the world but also for your pocketbook. You get with, upgraded systems, you have a longer longevity of the building, but also in time, lower operating costs, delivering, greater NOI. So you get some credit enhancement there. So you're getting structural and credit enhancement. You want to think of it same or different, but at the end of the day, it just adds to greater returns there. But I mean, with regard to, coastal cities versus inland or even Sunbelt, coastal cities are certainly the ones that need to be wary of, rising waters, but the rest of the country, can do its part in, upgrading systems and, operating the building as efficiently as possible.
Yeah, I mean, I guess what I'll add, and like Max touched on it, and it's with anything, it's incentives. Incentives matter. So, the green financing, I think with this new infrastructure bill, we have two different tax teams. Like, we talk in depth about this, at least once a month. There's going to be some incentives specifically for affordable housing, specifically for green financing. And I think we're going to see a lot more of that coming through Fannie and Freddie. I mean, you already see that they have an initiative where 50% of the money they deploy is got to be going towards something with an affordable component. So I think they're actually going to, at least they're going to need to come up with an actual a mold or some type of box of what that actually means. So once they do that, I think you're going to start seeing more and more capital go towards it. And then in terms of the actual, the climate change, I mean, I don't have a real great answer. We're buying some stuff in off the coast of Virginia right now. We close on in a couple of weeks. We have a few properties in Tampa Bay, but again, I think, when there's huge issues, going back to more of the incentives, I think, technology or, innovation is going to be there to, hopefully, come up with some type of solution to at least, buy us some time. Will it be a solution that, it's a one time, it saves us from everything? I don't think so, but it's going to buy us some time, and hopefully more and more innovations can come along and can continue to, preserve and keep places like Florida around instead of just, turning more into the ocean. So.
Thank you.
Sure. One of the things you three gentlemen mentioned is came to me is the intersection of affordable housing and demographics. One thing I saw up in my neck of the woods is a SUNY Purchase, where they actually built a senior citizen housing complex that's part of the university. So thinking about demographics, thinking about all these universities that are either going out of business, looking to monetize things, having dorms, etc. What inning are we in, or anybody is recognizing the utility of affordable housing on university campuses as it relates to small to mid-sized cities? Is that something that's on the radar screen of anybody at this juncture?
It's huge for us. So senior housing, you have a huge expense load, right? So we focus on private pay senior housing. So talking about affordable housing, or not affordable, assisted living, memory care, independent living. The more and more you progress up from, independent living to memory care, more, more assistance is needed, which means more cost. And your biggest cost for a senior care facility is your payroll. So if you're at a university, you could utilize, we're doing it right now on a property in the Midwest. You can utilize, some of the nurses that work there, and you can essentially get discounted labor because a lot of them have to go out and they have to do internships, or they have to go work for, one of these types of companies. So it works for them because they're learning how to work with seniors, which again, that demographic is just, it's going to increase. I think 65 and older increases by 50% between now and 2030. So it's huge. But it's great for us because it's getting us, labor at a cheaper cost instead of, having a nurse that's, been certified and has 5-10 years of experience. So I think it works hand in hand.
So student housing converting to senior housing. I don't know if any of you have been on a university campus the last 2 years, but they're very sad. The kids are sad, the whole thing, but there's a lot of repurposing that could occur just through the demographics and the way education has changed.
Yep.
So there are probably many opportunities to partner up with universities to monetize the unused dorms and excess space and so forth to just help build the communities that are getting a little older.
Right, and people want to be in the university setting in some cases, so actively going to Greensboro or Charlotte or Raleigh or pick these places. And many schools, yeah, certainly, and many of these schools are going under because they don't have enough students and et cetera. So there may be repurposing of that too. So it's something to think about. That's all.
Yeah.
I see 3 years from now talking about it more for sure. That's awesome. I'm running low on some of the topics.
5 more minutes.
Okay, good, perfect. So why don't we just wrap it up with, where you see the economy going over the next year. One question I wanted to ask that covers other things is how has technology changed your business? And it could be anything. I know mine's been disrupted, disintermediated by Zillow and StreetEasy and so forth, but some things have gotten a real benefit. So talk about technology and how it's changed your business.
I mean, I can take that.
That was a layup. I know you're a little bit involved.
Yeah, I mean, look, we're a digital mortgage company, and you've seen Rocket Mortgage, and you've seen Zillow, and all these other type of brokerage companies, whether it be mortgage or home sales. But I mean, the consumer is ever more, technologically native, and I think just more broadly, the education, the learning curve into real estate and real estate as an investment product has come down. And whether you want to think of that as kind of internet 1.0 leading that, or web 1.0, web 2.0 doing that, I mean, that's certainly a driver. But I mean, I think it's also shedding light on, how data can drive insight in purchases, but also lending in general, right? I'll say Zillow's, headline, which I'm sure many people saw, which is, they've offloaded, near a billion of single family homes, right? And it was kind of embarrassing for I think the real estate technology sector that boasts massive amounts of data so you can acquire intelligently. And, that's an example of, data not being all equal and making sure that there's a human element there. And, you can't fully automate this entire process, and relationships and humans, people are and will always be a driver of this, because at the end of the day, it's people making that decision to purchase or rent, to go to a digital mortgage lender versus someone, that has an office in their location. I mean, I think it's opened up many people's sights to how the world can operate and how the world can, embrace this disruption. Technology is really, I think it's accelerated a decade's worth of digital transformation in just 2 years. And, clearly even this conference, right, we have a hybrid model of in person and Zoom. I was actually at the conference earlier today. I had to run downtown for a meeting. Didn't make sense to come back up. So I'm taking this meeting from my place. So, I mean, there's a lot of practicality to it, but I mean, that's also how you're able to enhance a lot of things in general, right? Whether it be this conversation that we're all able to attend, with you guys in the conference, Peter in Florida, I'm remote. I mean, it enables a lot of productivity and I would say innovation.
Yeah.
Anything?
Yeah, we actually started in 2013 already a small subsidiary to a company which is a real estate angel investing, venture capital. So we've actually been involved in real estate tech for a while. And the first thing we did at that time was a crowdfunding company called Real Crowd out of California. They were out the Y Combinator. So that business model actually worked out and was accelerated with the pandemic. So it was kind of a fringe way to raise money before, and with the pandemic, the whole Robin Hood phenomenon and things like this help that business model. And I think real estate crowdfunders raised about $800 million in equity just during the I mean, from March 2020 to the end of 2021. There's a lot to do. There will be a lot more to do. I think the markets have been very hot, especially last year. Valuations are out of control. I think it's cooled off the last couple of weeks, but clearly, I think two trends that have been clear to us are that number one, it's harder to disrupt a lot of businesses than people think. Primarily two areas that are very blatant example of that is your business, brokerage, leasing or selling. Without the human element at all, it's still a little bit difficult to implement efficient business models. And secondly, construction. Construction, like with a company like Katera that was funded by SoftBank, was in the end not successful. A lot of other companies were not successful. It's still very, I mean, you know, you're building your house. You need to have guys with boots in the mud and a hammer and a helmet, and that's how it works. On the other hand, a lot more has been successful with software, dealing with property management, dealing with things like Affordability, dealing with construction in terms of budgeting and whatnot. So that's been successful. Other things that relate to climate change. We invest actually in a company named Moderator, which basically allows skyscrapers on Park Avenue to better monitor their boiler systems. Right. So, you know, a tower on Park Avenue, let's say the JP Morgan Tower, formerly JP Morgan Tower, is about $1 a second to run. So if you can calibrate your boiler to run when it's only needed, not at night, for example, if there's nobody in the building, or less at night, then the savings are very interesting. So that's my 2 cents on that. I think going forward, we will need more innovation that's efficient within the leasing and brokerage space and the construction space. It's a matter of time. We invested actually in a company named Knock, which does self-touring. You know, we realized in our markets in Brooklyn, a lot of the tenants, 25-year-olds or whatnot, don't necessarily want to even speak to a person in the day and age. Want to do it electronically, don't want to wait for a person to open the door and whatnot.
They'll text me from right there next
Well,
to you.
they're not all like you. Let's put it this way.
Yeah.
But that company has basically an app. Let's say tomorrow morning you want to rent an apartment. There's an intersection you like in Bed-Stuy. Let's say Marcy and Hancock, and you like that intersection. You can show up time you want, say 11 a.m. You open the app, you see everything around you that is available for leasing. You look at the pictures and the pricing and what you like. You can directly press a button, get a QR code, and open the door, tour yourself. And this way you can tour as many things as you want in as much time as you want. And if you want to apply, you can directly press a button, and everything is pulled. Information is pulled from your bank account and your sources and directly goes to the door. So we think that has legs. It still needs to be tweaked for the human presence maybe and whatnot, but we're positive on the technology. There's just a lot of stuff out there right now.
Yep. Any other technology that excites you, Peter, or maybe we can go on and on?
Yeah, we could. I guess I'll take a different angle of how technology has impacted us. So I'll go a couple different ways. I kind of talked about the manufactured homes, so that's pretty obvious. Building homes in, largely in a factory, and then transporting them to their ultimate location. That's one. Senior housing, you're seeing it more. I'd say 10 years ago, you wouldn't have Wi-Fi in every room. You wouldn't have all that, but it's needed now because of telemedicine. So that's huge. You definitely need to be more innovative on that side of it. On the conversions, I mean, the hotel conversions, you have a good portion of the residents that are the part of the work from home demographic. So we will take some of those common areas and make them into like little co-working stations. So that's the move we've made from being in person to being more maybe online or virtual. That's impacted us there, and that's how we've provided a solution for that need.